those who are joining me, just so you know, I put some pictures up on Instagram, and these are the pictures, photos that I'll be using today in my conversation about the commitment of trade report. So make sure you get them. I'll be using them. I send them to you guys, so hopefully that you can actually see them and read them. Right now they're a bit small as I go through them, but hopefully that I'm looking at them now. Hopefully that when I put them on the screen, you'll be able to read them. So that's what's going on now. So how you guys doing? There was a bounce in the market today. So, we had talked the last time we had met, we talked about the VIX and how I use the VIX, and that the VIX had given me several buy indications. And the VIX continued to give us a buy recommendation yesterday. And it was kind of interesting. As you guys know, I'm a college finance professor, and I was preparing for my lectures yesterday, and I literally went in to buy some more of the S&P 500 to go long. And I looked up at the time, and basically I just missed the time to get the order in, so the market had closed on me. But again, the VIX has given us our indications. So we had the bounce today. Based on our VIX and our indications, we should see a continuation. We should see a continuation in the market. Well, I'm just giving people a minute to kind of sign in, so I'm just reviewing some things we talked about. Last week, we also talked about how Zoom had run up, and Zoom had run up tremendously before the number and after the number. And one of the things I had mentioned to you guys, especially you newer traders, one of the things that happen is stocks don't go straight up, and stocks typically don't go straight down. And one of the things I had mentioned was that with that run up that we had in Zoom, I was looking for a retracement. I thought if the market held up that Zoom would retrace back to about the 370, 380, 370 level, if I remember correctly, we had talked about. I saw that Zoom had actually got down to 350. For those, again, traders and buyers, based on the fibs and the retracement, that was a buy down here, especially for traders, especially for long-term investors. We saw the same thing in Apple. We saw the same thing in Tesla. When stocks have a tremendous run-up in a short period of time, at some point, there's going to be profit taking. And think about it this way. For a lot of you guys, we talked about how you guys should use stop loss orders and how you should adjust. Well, there's a whole world out there also that uses what's called a trailing stop loss order, where it might trail the order with a 10% stop. So as the stock goes up, the stop loss will move right along with it, 10% below the price, and that stop will eventually stop you out. But the only reason why I say that is, if there's a lot of stops in the market, when a stock starts to sell off, what happens is not only is the market selling off, but those stop loss orders start getting hit. And it can be a chain reaction. So on the fibs, which we saw on Apple and on Tesla, and there was a retracement, which was pretty healthy. Now, as that retracement came, the market pulled back, and that's what caused more weakness in there. But you'll also notice that those are the ones that rallied back. So again, I do think there's going to be a major pullback in the market. As I've always told you, I don't try and time the market. I just look at what's going on and make my decisions there. So I do expect a pullback. When? I don't know. So we'll keep trading this thing based on what we're seeing and the information in front of us, and hopefully keep putting money in our pocket. All right, so we talked about that. I do have some questions, but I really want to get started with the commitment of trade report. The commitment of trade report is the closest thing you'll get to insider information on the commodities market. So let me explain what happens. Every Tuesday, so this past Tuesday, they collect data from Tuesday of the previous week to Tuesday of this week. Then they spend Wednesday, Thursday, Friday compiling this data, and on Friday release it. And what the commitment of trade report shows is, it shows all the transactions in the commodities market, but they break them down into who the investors are, who the people in the market are. Now, they have two reports. So let me, I'm going fast. I'm getting excited. I apologize. So once again, let me say it again. The commitment to trade report is the closest thing you'll get to inside information. It literally lists or shows as an aggregate every trade on the commodity in a particular commodity. Now the report comes out once a week, and it goes from Tuesday of the previous week to Tuesday of this week. They spend Wednesday, Thursday, Friday, compile that data. They release it on Friday. Now to break it down, the original report had three investors. It had the commercials, it had the non-commercials, and the small investor. Let me take it a step further. I'm going to work from the ones from the least important. How about I put it that way? Really don't care about the small investors. The small investors, all right. So, all right, I'm back. Oh, geez. I'm not sure if you guys lost me. I rambled on a little bit. I was just chatting. So I'm not sure if you lost me or not. Weak connection, rolling blackouts, as you know, here in California. So let me just start again. And the commitment to trade report, the original report, which is now called the legacy report, they break investors down into three categories. First category is a small investor. The small investors, me, mom, pop, they're buying one contract, 10 contracts, nothing really to get too excited about. The second group is what we call the non-commercials or the large speculator. What they really are is institutional investors. They're commodity traders. These are people that they make their living trading the commodities market for a living. They buy in size, but again, they're traders. And typically what you'll see with them is that they're momentum traders. So if something's going higher, they just keep buying it and pushing it higher and buying it and pushing it higher. Once it starts to break down and starts headed down, they go the other direction. They sell their positions and they start shorting and they push. All right. The third and final one, which is the one that we really key in on, are the commercials. Now the commercials are either they're producers of the commodity or they use the commodity. The producers are the ones that are buying it. It's their inventory. They're buying it to either make more product or another product. They're buying it to consume. But again, the commercials are the companies or individuals or businesses that is their business. So for instance, if we're talking about soybeans, a soybean farmer is a commercial. Now, let me go a little further. And I'm not trying to get deep here, but once you understand this, it's really powerful. I'm going to use the soybean farmer, for instance. And I got to add something to you because I always talk about this. The soybean farmer is not mom and pa kettle carrying a pitchfork with a piece of straw stuck in their mouth. All right? That's not it. Not anymore. All right? The commercials, the soybean farmer went to some college, got his master's degree in agricultural engineering. All right? That's what he's doing. And he's a business person. He's more likely to be driving a Mercedes than driving a tractor. All right, here's what they do. If the price of soybean is way too high, or they think it's higher than it should be, the soybean farmer is going to pre-sell soybean that he hasn't even planted yet. Let me say it again. If the price of soybeans reach a point where it's so high, a soybean farmer is actually going to go into the commodities market and pre-sell his soybeans at the higher price because he's expecting the price to come down and he's trying to lock in that lower price. He might not even, so he's going to do that. He might not even be planting soybean, but he understands what's going on. The price is so high at this level, we're going to sell it, make our profit, and go about our business. Now on the other side, if the price of soybeans start to drop really, really low, this farmer might say to himself, I'm not even going to bother planting soybeans right now because the price is so low. What I'll do is to fill my orders for clients, I'll buy the soybeans in the commodities market, I'll take delivery and then make delivery of where I have to go because I can buy it at a cheaper price. So what I'm telling you is the commercials typically are telling you where the market is heading. They're a leading indicator. All right. So let's go to some pictures. And I put this up here so hopefully you can see it. I know it's hard to see. I can't read it all. But what this is, and you can take your time to read it later, it breaks down who the commercials are and who the non-commercial traders are. So when you get a chance, take a look at that and read it. All right, let me move on to the next slide. Again, I have to find it. Now, what you're seeing on this slide is the commitment to trade report that's put out. They came out with another report. And this new report, now they put out both, but this new report breaks down the investors or the people trading in these markets into 4 categories, even deeper. So the main category, well, I'm going to read from the bottom up. Managed money are portfolio managers who manage money in the commodities market. All right, they're portfolio managers, they're buying and selling. Their goal is to make money for the clients. They'll make it on the long side, the short side, doesn't matter. Another group is the swap dealers. Swap dealers are traders in the commodities market, and they're trading and they're swapping these securities around. Again, the other one is other reportables. These are the smaller traders. They don't have to register. We don't know who they are. And then the fourth one, again, in this new report, they're producers, merchants, processor, and users. In other words, these are the commercials. The commercials, again, are leading indicators. So make sure you understand what I'm about to say. Commercials are leading indicators. The large speculators are the ones who drive the market. All right, let's go take a look. Let me make sure I can find what I'm looking for. I believe this one. All right, I got to give props now. And my props go to barchart.com. Let me say it again. My props go out to barcharts.com. The reason why my props go out to barcharts.com is all the data I'm doing today, every bit of information I'm giving you comes from barcharts.com. It's a free website. Don't get me wrong. They have a premium membership, which you pay for, but they also have a free. Everything I've pulled off of this is free. Now, what you'll see is this is what they did was this is the disaggregated commitment of trade. This is the new version of the commitment of trade, not the legacy. And what you see is that they broke it down, and the top one you're looking at is wheat. Now, as you look at wheat and you go across the top, it's showing that, and I know it's small, but hopefully you guys later on, you can pull it up and read it because I posted all these pictures on my site, on my IG. But you'll see that there's a short position of 109,000 contracts. That's the aggregate position. In other words, the commercials as a group are short 109,000 contracts of wheat. Now they show the net change, and net change is a negative 2,000, so 20,000, so that means they've increased the position. You can see the long position's 19, the change is a negative 28, the short position's 128. So if you look at the eye chart right here, you can see all this red is showing you that the commercials are basically net short. Now again, the commercials are the dealers, the people that grow wheat, use wheat, process wheat. These are the people that buy and sell wheat for their business. They're shorting wheat. They're saying right now that they believe the price of wheat is too high. This is my fundamental analysis. The commercials are telling you right now that the price of wheat is too high. Doesn't mean that wheat's going to go down right now. It just means that fundamentally they think that the price of wheat's too high and that they're playing for the market to come down. Now again, they're not speculating. It's key you get this. They're not speculating. If your company has to buy wheat, all right, if your company has to buy wheat and you saw the price where it is right now at this level, you would say to your company that the price of wheat is way too high. It's going to hurt us in terms of our inventory, but we have to buy it. The commercial, on the other hand, is saying the price of wheat is way too high. We need to start selling our wheat right now. Sell it into this rally. And what that tells you is they're selling up in here because they actually believe that the price will come down. All right, that's wheat. Let me move on to another chart. Bear with me a second. Hopefully this is the right one. I think this is the right one. I hope it's the right one. If it's not the right one, you guys, I will change it. I think I can't even see my own stuff here. It's so small. I do apologize for that. And I don't think that's it. I think this one's it. Yep, this is it. All right. I want you to look at something here. You're looking at, up top, a 3-year weekly chart of wheat. The reason why I use a weekly chart is so you can actually see the commitment to trade report here on the bottom. Again, the red are the commercials. You can see right here that the commercials, the red is commercials, you can see right here in the bottom of this chart, this red line, that the commercials are net short over 100,000 contracts. All right, that's what it's showing you. You can see again that going back, we can see that this is the shortest position they've had going all the way back to, it looks like August 2019. Now, if you take a look, which I always do, take a look, you'll see that this bottom right here in 2019, this bottom, look at what happened to the price of wheat. As that bottomed up there in commercials, the price of wheat was at a near-term high. And as that near-term high was there, as you can see right here, then the commitment to trade report, the commercials are telling you to get short. They're net short. The price of, as you can see it right here, I'm going back to 2019. I know it's hard to see. I apologize. But you can see that the commercials literally are showing you what the indication is of where it's going. This is the reason why I tell you when I trade commodities, I typically looking for a change in trend, a whole trend change. You can see it here on this report. Let me go to another one. Now I'm going to another commodity. Bear with me a second. Boom. Now, for the last couple of weeks, you've heard me say that soybean is a short, fundamentally. Here it is right here. You can see it. If you look at this chart, you can see, again, I'm looking at the red lines, what the commercials are doing. If you go back to May 2019, you'll see that at that point, soybean was at the highest price it was near term. And you can also see that the commercials were net short, the largest net short position they had at that particular time. And you'll see that from that point, soybeans pulled back over the next 3-4 months from a high of $10.60, pulled back to looks like a low here of $8.20. Let me make sure you understand what's going on here. For every penny move, every 1 cent move in soybean is $50. So you can see that was a tremendous move. And this is the reason why I tell you guys all the time, when you understand this, it is possible to make 5, 6, 7, 8 times your money on these trades. And you can see what happened. Now, the reason why I bring it up again is look at the end of the chart, where we're at right now. Once again, we are at a net short position. This is the largest net short position we've had in soybeans in the last 3 years, 4 years. That's as far back as I went. But you can see what's happening now. So all I'm going to do now is, this is my fundamental signal. I'm going to marry this signal with the 10-day moving average. And when soybeans cross below the 10-day moving average, I'm going to look to get short. I'm not looking to get short for a week or 2 weeks. I'm going to look to get short because, again, the commitment to trade report is a weekly report. It's not a short-term trade. I'm looking for a trend reversal. So I'm looking for this thing to stop spiking and start to actually start moving down. That's the fundamentals on this. Again, the commercials. The commercials are the farmers. The commercials are the companies that buy soybeans. Those are the commercials, all right? They're selling soybeans. They're net short. What are they telling you? The farmer's telling you that I'm selling all my soybean up here at this price at $9.79. That's what he's telling you. And the price is going to have to come down from here, all right? Because that's what's going on. They're all getting short. Now, I'm going to show you another chart. Let me see which one I have here. See if I can, again, I got to find it. Bear with me. I do apologize. But I put these up. And again, all these charts are, where are you? There you go. All these charts are on my site, on the IG right now. I put them up there earlier. All right. What you're looking at is soybeans. The candlestick is soybeans. The red line is the commitment to trade report for the commercials. And what you'll notice is, again, look at the spikes. Look at when the commitment to trade report for the commercials is at a net low. Look what happened to soybeans and what they did from there. Look at when the commercials are at a net high. You'll notice that when soybeans, it looks like here in the middle of, so it had to be back maybe, I'm not sure, I don't have the dates up here, but this is the most recent chart. I just had to cut the dates off. But you can see here that when soybeans bottomed out, you can see that the commercials are at the largest net long position they had been in. Again, all I'm showing you here is that this is a leading indicator. All right, you can see it. I've run calculations on this. For those who understand finance, know that the correlation coefficient measures how two assets react to each other. You can see that these two items, these two assets, the commitment to trade report commercials and the actual underlying commodity, they have a negative correlation. My calculations have come to the negative correlation can be as much as a -1, which means they're complete opposites. All right, that's how it works. Now, the next one I'm going to is, again, we're still looking at soybeans. But now what we're actually looking at the speculators, the large speculators. We're looking at the portfolio managers. And you can see that there's a direct correlation between them and the security, the underlying asset. So that's when I was talking to you about these guys push and push and push. They're momentum traders. So when we get our signal and we couple that signal with a move above or below the 10-day moving average, which is our indicator to go long or short. So if we get a signal like we got on soybeans to go short, and soybeans break below the 10-day moving average, that's when we want to look. Earlier in my Wall Street week, we talked about corn. I kept telling you corn was a buy, corn was a buy. I told you that I was in it. I told you also my timing was off and I missed it. Well, I was buying my corn contracts at 320, 321 around there. Corn is at 360 right now. So my contracts expired. Again, it happens. My contracts expired, and basically 30 days later, corn is up at 360. So whenever possible, just buy yourself more time. It's not a short-term trading strategy, but you can see what's going on here. Let me give you, I don't want this all to be about on the short side, so let me show you this. Now, the top two ones, the top one is green. What that's showing you is that the commercials are net long. The commercials are buying all they can get their hands on. They think that this commodity's underpriced and they need to buy as much as they can get. What you're looking at is the US dollar. Right underneath the US dollar is Bitcoin. If you go further down, the fifth one from the bottom is the Mexican pesos. Now, back in May, June, the pesos ran and ran and ran. The pesos was a hell of a trade back then. Now you understand why I said that fundamentally I am long the dollar. Fundamentally long the dollar. Now I'm waiting for an indication or a move, and it happened last week. Last week, long the dollar. I was not long, but I got the signal to go long the dollar. I've been telling you that. And last week, the dollar moved above its 10-day moving average, and the dollar ran. So when our market here was pulling back, the dollar actually was increasing in value. All right, let me see if I can pull up another chart. See if I can find it. I believe it's this one right here. What you're looking at now is the actual relationship between the commercials, again, and the dollar. And once again, you can see, you can just see it. It's a leading indicator. It's telling you what's going on. I highly recommend you follow it. let me show you what's going on next to that. So that's the commercials. And I'm just looking for the chart. You guys got to bear with me. I think that's it right there. Yes, it is. There's the large speculators. Look at them just driving the dollar up and driving the dollar down. That's what they do. They just push and push and push. They don't look at indications of what direction it's going in. They don't look at the commitment trade in terms of predicting if there's going to be a change, a fundamental change. In other words, going from a buy to a sell, going from a bullish to bearish. They don't do any of that. What they do is when they take that position and they're momentum traders and it starts to run, they just keep pushing and pushing and pushing whatever direction it's going. Once they see it start to sell off, they're going to take their profits. Their stop loss is going to hit. Now, some of these commercials, because of their sheer size of trades, they're not using stop losses. So they're going to actually hit the market and start selling. All right. I'm trying to see if there's anything. There's several other ones. I think I've done enough. I'm not going to go through all of them, but you can look at it. And that is my commitment of trade report and how I use it. What I'll do now is, bear with me a second. I'll just open this up for any questions on the commitment of trade report. I do have some questions, some other topics, so I'll talk about those. But again, that's how I use the commitment of trade report. I can't emphasize enough. I go to barcharts.com. All that data is free on barcharts.com. I've been using that data for the last 20 years, 25 years. I'm telling you, it's a leading indicator. It does work. The biggest challenge you're going to have is not that if they're right or wrong. One is the timing of it. You cannot time. And two is you can't tell the size of the move. Sometimes a move, like we've seen, you'll get this oversold or overbought condition by the commercials. And you say because of the sheer size, when they start to close out or cover that position, it's going to have a major run. And it doesn't. Other times I've seen it where I thought it was going to be insignificant and there was a major run. So all I'm saying to you is this is a way to check and check. The other thing I'm going to say to you is this. If you're using the commitment of trade report, one, and you're trading commodities, two, you must hedge yourself. So you can do it a couple of ways. You can just go straight long the call or straight long a put, because the most you can lose on a call or put is your premium. My suggestion to you is if you're going long a call or going straight long the put, if that option, if you lose more than 50% of the value of the option, 50% of what you paid for it. So if you paid $100, if it goes down to $50, my advice is to close out the position and move on to the next one. If you do like I do and use hedge synthetics, again, then I'll let it run. I'm not worried about my downside. And what I mean by that, I know it's there. I just know that I protected it because I hedged it. And because I hedged it with a synthetic hedge, I've quantified how much money I can lose. I know what that is to the dollar amount. My position size in commodities is always based upon how much money I'll lose if I'm wrong. All right? I always want to look at how much money I'll lose if I'm wrong. I do not want to wipe myself out on any one trade because I got greedy saying, oh, this is going to work, it's going to be big, and I go in for it, and it just basically wipes out my whole inventory, which is my cash. So, one more time, let me just say it. If you're hedging, then you can quantify exactly to the penny how much you'll lose if you're wrong. If you're just going long the call or the put, my advice is if it goes against you for 50%, down 50% from what you paid for it, close out the position. Doesn't mean you're wrong. You just don't want to lose all your money while you wait for this. The challenge you have all the time, again, is time. It takes time. Sometimes it happens right away. Sometimes it won't happen for 2, 3, 4, 5 weeks. You must be patient. Whenever possible, buy more time. All right. That is the commitment to trade report. That's how I use it. Powerful tool. Really, really powerful tool. My experience, again, is it doesn't work in every market. So we'll talk about that another time. But I repeat, don't use the commitment to trade report to trade the financials, the stock market, NASDAQ, New York Stock Exchange, S&P. I do not use it for that. And the reason being is because my experience has been in that, just following it, that the commercials typically follow the market. They don't lead the market. They're not a leading indicator in that market. So in other words, when the market's going high, they go high. When the market's going down, they start shorting. So I would not use commitment to trade for the financials. Interest rates, yeah. I got a buy signal on the 30-year Treasury last week. And when this market cracked on Thursday and Friday, the 30-year Treasury, I think, has spiked a point, 2 points. Now, understand, on a Treasury contract like that, full 1 point move is $1,000. So that thing moved by almost $2,000 over a 2-day period. All right, that's the commitment to trade report. I can go into more detail if there's any questions. My advice is go to barcharts.com, do your research on there, and literally just start looking at it and using it. In terms of platform, right now I use Thinkorswim. I've used Thinkorswim in the past. I've used Dorman. So I'm using Thinkorswim, which is basically under TD Ameritrade. They merged with TD Ameritrade. I know that Schwab has been advertising that there's no commissions on some of their commodities trades. So again, futures trade commodities, but I'm using Thinkorswim. Ooh, excuse me. Sorry for that. All right. Checking the time, 1:33. So let me do this. I got to close this out. A couple of things. So you guys asked me about some IPOs. Oh, can I type the website? The answer is it's hard for me to type anything while I'm doing this, but barcharts.com. There it is. One word, by the way, as you guys know, this auto spell check did that. One word, barcharts.com. And you want to go into the futures section, and from there you'll be able to find all the commodities, all of them. I highly recommend you take the time. Trust me on this. Take the time and just go through it and look. It's eye-opening. Several years back, they tried to stop the report, and there was so much uproar by investors that they said we can't stop the report. So they actually went to and formed this a whole new report. They expanded it. There was a push to try and get the New York Stock Exchange to start putting out the same type of report. Again, just think about what would happen if you knew as a group, if the portfolio managers were buying or selling Apple, if the portfolio managers, what their positions were, if they were long or short as a group. Just think about what you could do with that type of information. You can make money off of it. The New York Stock Exchange fought it and didn't do it. The commodities market does do it. It's really, really, really a powerful tool. Thanks for typing that for me, Tommy. All right. I forgot what I was going to say. You asked me about some IPOs yesterday. So I just saw that, and I know I'm probably pronouncing it wrong. Planterra is due to come out on the 23rd, and it's going to be, they're going to bring it directly to the public. So in other words, they're not going to do your traditional IPO process, bringing it directly to the public. Some of those have worked, some of them haven't. Probably the most successful one that went directly to the public and skipped institutions was eBay. Remember, eBay came public. I believe eBay came public through a Dutch auction at $85 a share. I'm not sure where Planterra is going to be priced at, but it's going to be up there. What makes these auctions really interesting is, and what really moves IPO stock and the IPO market are institutional investors. So these Dutch auctions where they actually allow individual investors like you and me, as I call us mom and pop, to invest in these things right off the bat and not allow institutions. Institutions are the ones that push this. So it's going to be interesting to see what institutions do with that. The other one, Snowflake. Snowflake's another one. It looks like, I'm not sure when the pricing is going to be. They came out with their first prospectus, the red herring. They came out with a secondary S1. Again, I think if I remember correctly, they're talking about pricing this thing around $85, $90 a share is what I'm hearing. But again, I'll let you know more from there. Now, the thing I need to let you guys know, which I kind of talked about briefly, is that when it comes to these IPOs, I can't, and most likely you can't get initial public offering stock. So the only chance you have to participate in this is actually by trading the stock in the secondary market. The other thing I'm going to say to you, having traded the IPO market for over 30 years, I do not know if you want to be a buyer on the opening. Typically, I don't buy the first day, second day. I typically wait to see what happens and see it settle down. So all I'm saying to you right now is that these are hot IPOs, but it could take a while. And I know you guys, a lot of you guys haven't done this like I've done it. So one that comes to mind was Alibaba going back several years. Alibaba was a hot IPO at the time it was coming out. It was one of the largest IPOs in the marketplace. It was hot. Everyone and their mother was trying to get stock and got stock. I don't remember what the stock was priced at, but it opened up at 85 the first day, ran to 105, 110, I think, by the second or third day. Got as high as 120, and then it backed off. Profit taking came in. You can't argue with guys. If they own stock from an IPO, Alibaba, let's say $34 a share that opened up at 85 and went to 120, you can't argue with taking a profit on that thing. Well, they took a profit on Alibaba, and Alibaba went down, and it took Alibaba almost 3 years, 2 or 3 years, I got it written down somewhere, to fight back and get back to that old high of 120 and work through. Now, why do I bring that up? Picture that you said, I'm gonna get involved in this Alibaba, it's a great company, it's hot, I'm gonna buy it, and you buy it the first day of trading, and you end up paying up for it 110, 120. It means you sat in that stock for 2 years waiting for it to get back to what you paid for it. So all I'm saying to you guys is, when it comes to these IPO stock, if you're not getting deal stock, you need to sit back and be patient and then watch the stock trade for a couple of days and then make your decision. Now, I have a whole process on how I make my decision and what decision I make. I'm not going to go into it. I can't go into it. It's just too long. But one of the things I will say that I'm looking for it right now was, I don't see it. Hold on a second. Here it is. So I'm looking. Where'd you go? There it is. All right. So the stock was off a little bit today. So I do have a position in an IPO stock that came public a couple of weeks ago. I'm not going to talk about it now. I don't want to talk about it because I don't want you guys trading that stock. I just don't, it's already made the move. I'm in it. And I just don't want you guys chasing behind me trying to, hey, Professor Milligan recommended a stock and I'm in it now. I lost money. That's not how it works. I'm here to teach you how to do it yourself. Make your own decisions. Make your own decisions. All right. Chewy. I was asked about Chewy. I looked at the chart. I still can't figure out Chewy. Now, Chewy's due to report. Chewy's due to report tomorrow, I believe the 10th on the close. And when I looked at Chewy, I'm looking at it again now. I know that, bear with me a second, I'm just going to a 5-day chart. Yeah, actually, let me go to a little longer chart. So Chewy had a run up. Where's my chart? There's my chart. Chewy had a run up last week, and it spiked, and then it came basically back like everything else did last Thursday and Friday. And then you see it yesterday, it kind of rallied a little bit, and then today it rallied again. So volume was kind of heavy. Here's the deal I'm going to say on Chewy, and that is, how can I put this? I'm not sure if I'd be trading Chewy right now. How about that? All I'm saying is I'd probably wait for the number. Slack, which is work, came out with their numbers. They beat on revenue. They beat on earnings. They did not give any forecast. They talked about how some margins were not what they were expecting. And the stock sold off. It was down, I believe, 25%. Now, the stock had run ahead of earnings. The stock beat revenue and earnings because they're in that part of the cloud technology, the whole Zoom. They're in that space, but the stock just didn't hold up. And that's what I worry about. There's not much hold up in a lot of these stocks after the number. All right, let's see. I will talk about SPAC later because I have to talk about, what am I talking about now? I had something else to come up. Anthony, good to see you, Anthony. Mr. Wright, I promise I will get to that. If not, I will get to you personally because you're one of my favorite people. But I will get to it for you. The other one, Peloton. Peloton, that's what it was. I couldn't remember what it was. Peloton. Peloton's another company that's doing well because of the whole pandemic lockdown. People are forced to stay home. They can't get out to the gym, so they're buying that equipment. They're using that equipment. Peloton's chart looks unbelievable. But once again, this is just me. I would wait for after the number, just because and trust me, you're talking to a guy that would trade a stock before the number. For those who want to trade Peloton before the number, I'm not sure when they're due. I think they're due tomorrow. I'm looking right now. Bear with me a second. Yeah, they're due tomorrow, unconfirmed tomorrow. I'm not sure before market opens or close, but they're due tomorrow. Let's see, consensus is a loss of 20 cents. Oh, sorry, loss of 18 cents on from 24 analysts. So that's what they're forecasting. Again, I would just wait for the number. They're benefiting from the whole pandemic. They're benefiting from that. But I would just basically wait. Now, with that said, for those who want to be aggressive and speculate and be aggressive, a synthetic will work for you. A hedge synthetic will work for you. And the reason why I recommend a hedge synthetic, because it will work for you because of the volatility. So either it's going to work big. So in other words, if Peloton misses the number or reports some negative news, the stock could pull off because it had such a run up. If they beat the number, I'm not sure how much run up we'll get on a beat number, only because I think a lot of it's factored into the stock price already. All right, bear with me a second. Somebody's asking me about this shell again. And as I mentioned, it's Tortoise Acquisition. I just don't deal with acquisition stocks. They have as much downside as they do upside. I would look, so let me make sure I clarify that. I'm talking about trading the company that's being acquired before the acquisition. I'm not a big fan of it. As I mentioned last time, in some cases you have as much downside as you have more downside than upside. I mean, how much more can the stock go if they accepted a bid and the price? How much more can it go? If they accepted a bid at $70 and stock trading at $65, you're going in there to make $5. All right, not bad. But if that deal gets canceled or postponed or something happens, and that stock will pull back to where it was. So I don't see much upside. Now, with that said, after the companies merge, I'll go back and look at the companies, and that might be something I want to buy because of the merger, but not trading the stock ahead of the merger, if that makes sense. All right, that was that. Yeah, Peloton launched some new products. Peloton now has a treadmill. They've got the bike. They also have the products that you can sign up for and just get I have my own stationary bike. My kids told me I should sign up for Peloton so I can have somebody to ride with. I'd rather ride to music, so that's what I do. I either ride to music or watch a sporting event. But that's what's going on with Peloton. All right, let me check my time. You know I always have to check my time. All right, so we got 15 more minutes. One is I'm checking to see if there's any more questions. And I gotta bring this up for you guys. I've been thinking about this really for the last couple of days. I kind of mentioned it in the past, going back. I know a lot of you heard me say this before. But one of the things, we're leaving earnings season. Now, as I mentioned to you, earnings season, which comes 4 times a year, is usually a catalyst that can drive stock prices up or down. As we had talked about, when they beat earnings, they beat revenue, positive news, it makes us all go back, readjust our valuation models and determine which way we're going to go. All right, so with that said, I believe, and I will show you, that you can take the headlines right out of the business headlines, right out of the business pages, and that's enough information for you to get started in terms of finding a trading idea, an investment idea. Now, let me add to this. One of the things that I always talked about with my students in class, I always talk about with me, and I'm talking about with you guys now, is what's going to make the stock go higher? What's the catalyst? Now, follow me now. When the market started recovering from the sell-off back in February, March, when the market started recovering from there, if you went long, it was a no-brainer. And the reason why I call it a no-brainer was the market was recovering and institutional investors just basically pushed the stocks right back up. Now we're in this phase now where those stocks have been pushed back up and you guys are starting to see that stocks are going down, they're going up, they're moving sideways. That easy money that was made when the stocks ran up is no longer there. This is requiring you now to think this thing through. So my question to you is, as you look at a company, ask yourself, what's the near-term catalyst? That's the word I'm using, catalyst, that's going to drive the value of this business. The second question is, after you identify the catalyst, how long can this catalyst last? So let me explain what I mean by that. I'm going back. I got to go back. And I'm not trying to go back, but let's talk about Tesla. Why did everyone fall in love with Tesla? The catalyst was the electric car. Another catalyst that came along was energy prices went to $150 a barrel for oil. Gas prices got to $5 a gallon at the tank. We've also seen shortages of oil. Those catalysts pushed the demand for electric car, which pushed the stock price or the revenue growth in Tesla. Anytime you start to look at a company, ask yourself, what's going to drive the value of the business? Then, how long can that drive last? Is that making sense? I hope it's making sense. You got to ask yourself that. If you're just buying the stock because the stock price went high and you have no idea why it's going high, what's driving it, then what that means is eventually at some point the stock price is going to start to drop and you're going to panic and sell. And it could be the stock price dropping could be a great opportunity to step in and buy the stock. Now I'm going to give you a couple other things. Amazon was a category buster. The catalyst that drove Amazon and is still driving Amazon is the fact that they are doing it better on the retail. All right? They're able to deliver product better and more efficiently than you going to the actual brick and mortar. That catalyst drove that stock, that company. That catalyst also, think about it, that catalyst also drove the retailers out of business. This is why I say to you, if we go into the newspapers and we start reading the headlines, we'll find things that are going to drive the value of the business. We'll find catalysts. And then the question is, after we find catalysts, we'll go, okay, how do we make money off that? So here's what I want from you guys. I need your help. And I don't need your help to help me. I need your help to help you. I need you guys next week to start sending me or tell me what you're seeing in the newspapers. Just the headlines. So in other words, I don't need all the details. And I'll give you a prime example of something that just happened recently. We saw that just now. Several of the airlines have announced that they're not going to be laying people off or furloughing, that they worked out a deal with the government. All right. We also saw, follow me again here. That was airline stocks. We also saw that, I'm smiling as I say it. We saw lumber prices go higher. We also saw we're at the lowest rate we've ever had for mortgages. Ever. If we read into that, what is it telling us? We got to keep an eye on the housing market. The builders as well as the housing market. Why? Because more and more people now can afford to buy homes. The rates are lower. The other one that you look at now is just thinking about that is keep my eye on Rocket Mortgage, which just went public. This is how we take information from the newspapers, take information from there, and we apply it. As you read these things in the newspaper, always ask yourself, how can I make money off this? So my homework for you guys to help me help you is next week, or as soon as you can, start hitting me on my IG box and tell me what you're seeing in the headlines. And then we'll talk about how you can make money off that. Now, sometimes you can't. I've had people come up and say, Mike, what about this one, about that? I said, wow, that's interesting, this is that. I don't know how to make money off of it. I haven't figured it out. So that's what I want you guys to do. We have to learn how to react to news with a forward-looking view on it. Not how to react to news. So news comes out and we decide, oh, that news came out, it's bad, let me just go out, the stock's going down, let me go short the stock. No, let's be forward-looking. What does that news tell you? We got to find a catalyst. What's going to drive it? So a lot of you say we should buy Disney stock. What's driving Disney's value? What's going to drive it? I'm asking, I'm not telling you. All right? People out there buying JCPenney. What's going to drive the value? Kanye West? Come on now. Ask yourself when you're buying these stocks, what's going to drive the value? Because if the value of the business goes up, the stock price is going to follow. It has to. All right? So ask yourself, what are the catalysts? As you look at your portfolio, ask yourself, what's going to drive it? Now, last week, Christian talked to me and asked me about the largest manufacturer, I believe, of school buses. And he said to me, he said, Professor Milligan, I'm thinking about shorting this stock. I've been watching, I'm thinking about shorting it. That's forward-looking thinking. Why? Well, we're having problems with the schools. You know, the pandemic. People are keeping their kids home. The demand for buses. What's going on with the demand for buses? They're probably going to slow down and drop. And any school district's probably saying, we're not going to spend money on new buses because we have this whole social distancing problem. So we're going to spend money other places. That's forward thinking, guys. That's finding a catalyst. In his case, he found a catalyst that was going to drive the stock price down, and he got short. A couple of years back, and I got to watch my time, a couple of years back, several of my students went short GameStop. And you guys, I know you guys have heard me talk about GameStop for the last couple of years. But why did they go short GameStop? And the reason why they went short GameStop is because the gaming industry started streaming the games directly to you. So you guys no longer had DVDs that you went back to GameStop and sold them and swapped them for new games. It crushed their business. They're trying to figure out how to stay in business. The stock basically went from $35, $40 a share down to $6 where it is now. At $40 a share, they had an activist step in and try and drive the stock price up, and he did. He drove the stock price out, showed his position, and then the stock just dropped. The bottom line is, what's the catalyst that's going to drive the value? What's the catalyst that's going to not drive value? All right? I know I beat that up a lot, but again, I think it's that important that you guys need to understand it. I know I have it somewhere. I'll see if I can put up. I put together a little short blip on it. I'm not sure where it is. I'll see if I can find it. But I highly recommend you guys start asking yourself. And by the way, catalysts can be short term. The other question you ask yourself on the catalyst is, what's the duration? And what I mean by that is, how long is this going to affect it? So I talked about this last time, another time ago. Nike comes out with a new sneaker in 2 or 3 different colors. All right, everyone lines up to buy the sneaker. Nike's a smart marketing company. They'll wait a month or two, and then they'll come out with the sneaker again with 3 new colors to try and drive demand again. The reason why they wait 3-4 weeks is because they know the duration. The duration of the impact of that sneaker on the marketplace is only going to last 3 or 4 weeks. Then they come out with another sneaker. All right, that's a very short duration. I'm not sure if I can trade Nike stock based upon a new sneaker coming out because I'm not sure what kind of effect it'll have on it. But you got to ask yourself, what's the catalyst, and then what's the duration on it? Now think about this. When it comes to Google, Google's catalyst was they had the fastest search engine in the world. I mean, bar none. That catalyst of having the fastest search engine in the world carried through almost everything else they did, and they expanded upon that. And that's what is driving the value. Ask yourself again, what's driving the value? What's driving the value in IBM? Microsoft. Artificial intelligence. All right, guys, I'm looking at the time now. I have to hop in the next couple of minutes because if I don't, I won't get this recording. And as you know, I keep these recordings and I post them on my YouTube channel. So I gotta hop. I like that. Red Hat. Red Hat was acquired by Microsoft. Red Hat was acquired by Microsoft. Microsoft acquired them. And again, what's interesting is, going back some years, I think it was Trevor that we owned Red Hat, and we owned it for that reason. There was a catalyst in there. I believe it was was it Microsoft? IBM. IBM. As I always tell you guys, don't get old. Memory, the things I forgot more than I'll remember right now in terms of what's going on with these different stocks and companies I've been involved in over the years. All right. Any other questions? Anything? IBM? Yeah, IBM took over Red Hat. And IBM has what? IBM has Watson, I believe. Watson is IBM's artificial intelligence, which is what drove that value for a while. I believe it's Watson. They all got their own version of Watson, Siri. They all got their own talking, so forth and so on. All right. I do appreciate all you guys. Hey, Anthony, it's good to see you. It looks like that you're actively involved in the marketplace, so I look forward to your input, your questions, and so forth. And I appreciate you guys coming out. What's that? Yep, and they're Kubernetes. I don't know what Kubernetes is. You guys have all these slang terms. I'm an old guy, man. I got to hang around you young people more to find out these slang terms. I'm not sure what Kubernetes is, or maybe it's something I should know, but I don't. All right, guys, it's a pleasure. Got to hop because I want to keep this recording. I will talk to you later. Thanks again for joining me.